Good morning, everybody. How's everyone doing today? Liked, thanks, NW. First, I'm first. I'm second, and Friday was my birthday. Birthday? Happy birthday, Proving Crown Builders. Tell your brother I told you happy birthday. Up, what up, non-secret Peter Sunday? Bueller. He's not here. All right. Good morning, everybody. I'm not first, and I don't care because I have brisket breakfast tacos. That sounds really good. Yeah, doing well. It was an okay weekend. Gork, it's noon. It's 12:30. Should I be ashamed of myself? I woke up to a woman larger than me width-wise. I'm 6'4", 240. Well, I don't see why you'd be ashamed. You didn't have to tell anyone about it. If you were, you'd think you'd keep it to yourself. What time of the year or month do you think is best to visit New York City? Um, the springtime's usually pretty light on tourists, and the weather's nice. Or the fall, like early fall, like early October. Wait, this isn't a confession channel? No. I would definitely be ashamed for not remembering falling asleep next to someone. Yeah, this seems like the actual problem here, is that you don't remember any of it. I think your anxiety about losing your job is becoming detrimental to your health, Rims and Tims. Is Kenny a bedbug now? Is he biting Todd in his sleep or something? I don't know about that. I don't know what Kenny's up to right now, but let's see. Is everyone here? Most people here? There's a few people here. That's good enough. All right, so I wanted to take a minute and try to explain to people the BOJDD I wrote, because frankly, I don't think any of you understood it. That might be my fault. It's a complex topic with a lot of moving parts. BOJ, not BJ. Yeah, BOJ, Bank of Japan. Hey Greg, sorry if this is a personal question. I have the choice of starting work now or going to college for another year. With the upcoming recession, would putting off employment a year be smart? Maybe. Um, that's a good question. Yeah, that would depend on the value of your degree, I suppose, which is, largely dependent on your own ambition. So, I don't know. What would you rather do? Bank of Jacksonville? No, leftover beefcake. Welcome to Dillionaire, man. Thank you so much. Hit me up on the Discord after the stream. I'll get you
Happy
added.
birthday, Gurk.
5 stars.
Yeah.
Thanks, Proven Crown Builder.
We might have
BOJ
cheese.
changes their yield curve. Oh, Jesus Christ, that's loud. BOJ changes their yield curve. That throws off the currents in the Pacific. Hawaii goes underwater. Economy tanks. Easy. No, popcorn trader. That's not what happens. Okay, so this is gonna be a bit drawn out, but I've given some thought on how to explain this in a way that maybe people will understand. I doubt they will. But maybe they will. And try to bear with me here. Okay, so let's say you're a US bank. Any of them. I don't care which one. Pick one. And you're sitting back here in 2021. You have money flowing in like crazy, right? The Fed is easing. Free money is being distributed to you, your depositors, businesses that deposit with you, and businesses that conduct transactions and lending with you. Right? All this free money is flowing in, and you don't know where to put it. So you start buying up treasuries at low yields. And let's see, we can do like the US 02. Let's do the 2. Right? And these fucking yields are rock bottom. They're shit. But you've got to put the money somewhere. Because, mortgages have a shitty yield. Everything's bad, right? So you're pumping all this money into these low yield securities and offsetting these huge depositor inflows, right? And this is, one investment, and you're trying to lend out as much money as you can, but, the mortgage rate's at like 2 to 3%. You're not really killing it on mortgages either. But the demand is high, so things are working out. Then the Fed starts to increase interest rates. Now this puts the yield of the securities you bought massively underwater pretty quickly, right? The rate of the Fed rate increases through 2020, end of 2021 into 2022 was pretty rapid. We went from, an effective federal funds rate of basically nothing, all the way up to like 4.85, right? By the end of the year. Specifically in this period following August, where, we saw multiple 0.75 rate hikes. This is a pretty big problem, right? And this creates a lot of duration risk. So US dollar is going up because the yields are going up on it. And you're sitting on this big bag of shit securities, right? I'm confused. How do I get free money? You don't. There's no money for you in this. This is for other people. Okay, so you start to take those underwater securities and you want to find somewhere where you can place them that has a lower interest rate, right? And Japan makes sense here because Japan's monetary policy puts them in a position where they don't really have like an effective central bank rate. It's usually 0, right? Or negative 0.1. So Japan is very willing to lend money, and when you take your 30-year or 20-year US Treasury to them that's at like 2%, that's a pretty good deposit for them, right? And they're going to collateralize that for you and give you leverage. And then you can take that leveraged loan money and you can, through your financial intermediaries, bring that money back to the US, where you can then lend it at the now much higher interest rates, right? So you're taking your 2%. Bank of Japan's getting 0.5%, right? And so if you're collateralizing this, you're losing 2.5%. These figures aren't accurate, but they're rough. And then you're lending. Now you can leverage up that money 1 to 2, 1 to 10, right? And you can bring that money to the US and you can lend it at point 6 points or 6.0 or 7.0% to literally anybody that'll take a loan, right? And now you're making money on the differential here, right? So you're losing 2.5% on your 100 million. You're losing 0.5% on whatever you levered up to, right? Like let's say you deposited 100 million, you levered it up to $1 billion, right? You're losing 0.5% on $1 billion, but you're making that difference in the yield, right? Which is, probably like, let's say on the low end, like 5.25%, right? So you're making the effective federal funds rate as it stands right now in difference in yield arbitrage. Now, since this creates a lot of risk, you can hedge by going short the yen, presuming yen yields stay low. And you can go long the dollar, presuming dollar yields continue to rise, right? And this is called a carry trade. And this is probably one of the most popular carry trades in the history of all carry trades. And this also works with the euro right now as well. And so we have this going on the euro JPN currency pair as well. But basically, this allows you to hedge your interbank asset risk against the yen, right? Here's the problem, though. It makes the risk presumption that Japan will not raise their rates. And when they raise those rates, they don't just raise those rates on your initial deposit of 100 million. They're raising those rates on the leveraged amount of money you're taking and loaning elsewhere. And in doing so, not only do they create an extreme amount of risk within the leveraged assets that you've moved to other countries, they also increase the value of their currency and decrease the value of the currency you're using to hedge. And so the yield in both your interbank asset risk and the yield in your hedge simultaneously get tighter. And this creates a ton of risk all at once. And you think it looks small, right? It's like half a percent point of interest, but it's not. It's 100% increase on the leveraged assets. So 0.05 to 1.0 is a 100% increase on the leveraged assets, and then also the effect of the rate increase on your hedge of those assets. Now, my theory here is that all of this, like this risk off shit we've been seeing since January, we're like, they're risking shit off. Like, but the question was always what? What are they risking off? I think this. I think in December of 2022, SVB had $209 billion worth of assets. In December of 2022, the Bank of Japan raised their yield curve control policy on their 10-year note from 0.25 to 0.5. And I think by March of 2022, SVB was insolvent. Um, I think that every bank in the U.S., all of them, in some degree, are highly incentivized to participate in this trade because they need to continue to lend in a high interest rate environment, but they can't lend money borrowed from the Fed. So our central bank charges, 5.5%, right? This is the effective federal funds rate right now. Bank of Japan charges 0.5. It's very obvious which of these is more advantageous. So you ask yourself, with the federal funds rate continuing to rise, how is it that lenders have not faced any kind of credit crunch? And it's very simple. They're creating a credit bubble somewhere else. And I think they've participated in this trade more and more and more. And as the federal funds rate continues to go up, that protects their yield unless the Bank of Japan's rate goes up faster than the effective federal funds rate, right? 0.25 increase on 5.25 is not nearly as impactful as a 100% increase on 0.5, right? So, and this trade and this situation were largely responsible for the beginnings of the 2008 crash. And I'll show you guys some data on that in a second. But basically, they did this in 2008 because US interest rates were really high. There was a huge yield differential. And then US rates started to drop as we entered into the beginnings of the financial crisis, and they had to unwind this trade really, really rapidly. And since they'd used Japanese funds to buy all these leveraged mortgage assets, when they started to unwind, they started to devalue those securities, which ultimately led to the collapse of Bear Stearns and Lehman Brothers, because the assets they had weren't worth anything because everyone was unwinding this trade, right? And I think we're in a really, really similar situation now. So, questions? And this all lines up. Also, I mean, if you want to look at the dates and the times, hold on, I do have data. This isn't just arbitrary nonsense. So these are deposits at the Bank of Japan, starting from September 2022. Give me 1 second. So we have this is the Fred data, but as you can see, the total assets, so deposits from member banks from September of 2022 till now has basically skyrocketed to exceed the levels during the free money era of 2021 into late 2022. And this is a interbank asset. Hold on 1 second. Let me. This is the intrabank asset levels. Relative to security broker asset gains in the same period of time. And the unwinding of the trade that you see beginning here is very, very similar to the unwinding of the trade that we saw at the end of 2008 into 2009. So basically, as they unwind this trade, they create more equity value, right? But the problem with doing that is your equity value starts to exceed your risk value, right? And you create basically you create like a lot of density in your equity value. And what that does is basically it means that your stocks become or your equities become worth more than they actually are. And that makes it difficult to sell them because there are fewer buyers. That can be represented with this. And so I think what we've seen is basically a risk off of this trade starting in December and possibly accelerating now as of the news the other day with the yield curve control policy being raised yet again, another 100%. One second, let me show you that one. There we go. So you see here in this upper range, right? This is where equity value starts to significantly exceed the value at risk. So I think with yesterday's change, they need to start unwinding this either faster or they need to start getting out immediately. Now this affects almost all the things we're talking about. It's beneficial to short oil because you keep Japanese inflation down, which you know, prevents their central bank from moving forward with a more restrictive policy. It's beneficial to short US treasuries because you keep the yield spread wide. It's beneficial to pump equities. Well, equities pump just anyway as a factor of removing risk from the credit bubble. So I mean, I don't think there's a lot of things this doesn't link together. And the amount of leverage possible would explain the kind of price action we're seeing in like SPX options trading and the it explains the source of the huge amounts of liquidity that don't appear to be present in the system. They're not. They're huge amounts of credit. Thanks, Cobra Pit Boy. Okay, you have my attention. What's the timeline comparison to 2008? I think this is a lot bigger than 2008. I think it's been going on for over a year now. I think every bank is incentivized to be doing this. Whereas back in 2008, it was mostly hedge funds. I think they started risking off already because if we look at Bank of Japan open lines of credit, hold on, give me a second. Let me delete that and then save this. Since end of 2022, this is commitment lines and the amount of outstanding commitment line contracts in units of 100 million yen. Give me one sec. As you can see the behavior in 2008 to 2009, right? You know, where interest in this peaked, and then you know the descent into the crash and depression. The current rate of fall off in this interest is much more rapid. How to protect equity assets in a 401k or IRA given this risk potential for a 2008 style decline? Are puts on indices the best way to generate profit in this scenario? They could be a way to generate profit or hedge. it could be a way to, yeah, or also get Vega exposure. It could hedge or add profits. Um, there are other ways. I mean, you can take 401k as an IRA and go to cash. The impact of this may not be the same. There's a lot of macro factors here that are different, and regulation and stuff than they were in 2008. So the unwinding of this may not have the exact same outcome, right? It's just a very similar situation. It's, well, it's not really density. But that's the best way to explain it. The value of their the value of their equity becomes highly concentrated and top heavy. Shit, so this could really be a big catalyst for a market downturn. Yeah, I think so. Could this usher in digital currency faster? Maybe. Is this just more bear market fuel that doesn't play out as expected, or are the mechanics kind of set in stone? Well, we don't know how much risk exactly is being taken, right? We have some data. Bank of Japan's a lot more transparent with their data sets than U.S. banks, obviously. So we do have some data from there, right? We don't we can't necessarily prove the amount of risk tied up in this trade, but it's been heavily incentivized since the Fed started raising rates, and it's only become more incentivized as those yields have expanded, right? Um, a good rule for the market is that, if there's incentive to be in a trade, someone's in it, and the more incentive there is in the trade, the more participants that trade will have. What happens when they risk off? Do bag holders get wrecked? Yeah. Well, here's the thing: is someone's gonna get out first, right? And I think that's what we saw last week. I think we saw someone exit this trade very rapidly, right? And the reason I think that, and the reason that this idea popped into my head in the first place, was because it wasn't like that risk off that we saw last week on Thursday. Not only was it simply upon the announcement of the potential for them to raise their effective rate, right? So it was just simply a rumor, like they might do this. And then we saw a multi-asset class risk off in almost everything: oil, dollar, yen, euro, equities. The yields on U.S. Treasury skyrocketed, right? So I think that the amount of risk is pretty significant. And then the next day, right, we start to see accumulation of short interest on SPX, something we haven't seen in like 3 months. Because I think someone's out. And that, yeah, that does mean that the people left are holding bags, right? First one to the door. So potentially more people will be joining the Wendy's dumpster gang. Maybe, yeah. Timeline of the expected unwinding. I mean, let's see. They started unwinding positions back in like end of 2006, and that carried all the way through into the crash of 2000, like 2008 into 2009, and the position was mostly extracted by like 2010. So it's a probably a long process, but the rate at which it's being risked off is much more, as you can see on this chart right here, rapid. So I don't think historic price action is necessarily a good predictor. I don't think this really is like a tradable thing necessarily. I mean, it could be given a long enough time horizon, but I do think it is something that is happening. I mean, the way out of this for banks is the Fed rapidly raises interest rates again. But another bout of inflation could mean that Japan moves to a more restrictive monetary policy, and the rate at which Japan would increase would massively exceed anything that the Fed is going to tack on to the current like EFFR, right? Say if Japan implements a policy of like 1.5, right? They move up 100 basis points. That's a 200-300% increase. Whereas, the Fed's gonna, like, the Federal Reserve is only gonna do like 0.25 or zero point 0.5, right? And that's not really a significant increase in the yield structure. Um, so Japan is the risk here. Japan and Japanese inflation. Japan tried for 30 years to get inflation, and now they've got it, and now it's at risk of going higher. So the situation there, which has always been a safe haven for this type of transaction, is rapidly deteriorating. Japan is exposed to oil prices and core inflation, just like us now. And if their inflation increases excessively beyond their target range, they're going to have to raise rates, which means that the Japanese bonds will become incentivized. Japanese investors are largely the largest holders of U.S. Treasury securities, foreign holders. So they're going to want to sell and buy Japanese bonds, right? Or drop their duration risk in U.S. Treasuries and move over to bright shiny Japanese government bonds, right? So obviously that can create a massive liquidity drain in the Treasury market. Um, that was my second point. What question was I answering? Timeline of the unwinding. Oh, and in the currency trade, I mean, the yen is going to rocket. It's massively sold short, so shorts are going to start to pull back, which increases the amount it goes up, right? And they're going to sell their long dollar positions, which is going to tank the value of the dollar in relation to the yen, right? So you get the dollar squeezing down and the yen squeezing up simultaneously. Does the giant short position open on Thursday on Lulu and no news for September monthlies fit into this theory? It does not. Also, you don't know if that's short. This could just be sold puts, right? I mean, like, the assumptions that need to be made there are pretty big. You need to look at the skew and see what effect on IV and spread that position had. I feel like I went from C to a B plus on the BOJDD test. Had a question you answered as I was writing. Pickle Wizard, thanks for awesome flakes. Do you think the two steep drops in after hours, the 706 and 710, are also the first signs of that unwinding? Probably not. Maybe if they were surrounding Bank of Japan rumors or like public commentary, but I doubt it. Could the creation of the Mag 7 also be a effect or side effect of this? Yes, that's what the over concentration and value at risk implies. Is it because you're risking off, right? So you're holding on to your core assets, your most valuable and secure assets, and those keep going up while you try to sell off your other equities, right, in order to meet, well, what's effectively a margin call. And so yeah, you create a lot of concentration risk. Time to buy puts, average down for the next 5 years. Let's fucking go. If Japan does now have inflation under control and at risk again, are they likely to try to get it under control quickly? If Japan does now, they don't have inflation under control right now. They are working on getting inflation under control. Are they likely to try to get it under control quickly if it presents a serious risk to their currency, which is already currently trading at a range? I mean, briefly, it traded at like moderately okay value, but their cap on their currency is supposed to be like 140, right, to the dollar. And currently the yen's trading at 140, 114 to the dollar. What's even worse about this is that by doing this, uh, and by allowing this process to continue, Japan has effectively neutered their ability for 30 years to create inflation or growth for the general public, right? In favor of allowing these multinational banks to come in and pillage any inflation increases that they would have gained by arbitraging them with US yields. So if not down now, up. Well, I think up until risked off, right? And then down. I mean, if we want to look at '08, which would be the best historical comparison, although this trade did collapse going into the pandemic, which you actually see it being risked off here as federal funds rates started to drop. So this trade did risk off into the COVID crash, and then massively so when the US side of the yield curve collapses. As a matter of fact, I would be so bold as to assume that the reason that we see market crashes after the FFR is reduced is not simply because of the movement into bonds, but because these currency trades collapse. Because the yield spread drops to nothing. So when the Fed emergency lowers rates, I think these are what cause those market crashes. These paired carry trades on currencies with, and here we are back in here we are back in '08, right? So you can see as the we had this huge risk off period where US rates started to decline, right? And then as they started to move those rates down more rapidly and the spread reduced, 2027 SPX puts on the menu. I don't know if it's going to be that much time. Because generally speaking, the spread is reduced on the US side in this carry trade, right? Like in 08 and 2020, you know, the spread is collapsed because the US drops rates. But we've never, I mean, at least in 30 years, we've never had a situation where the spread is collapsed due to the Japanese side, with one exception, and I do want to highlight this as well. In 2017, 2016, sorry, the Bank of Japan, hold on, let me get rid of this. So right around here, the Bank of Japan implemented their yield curve control policy. And this effectively blew up billions of dollars worth of assets immediately, because yield curve control went from negative 0.1 to positive 0.25. Within a year of that, we had Volmageddon. Also, I mean, look at the equity value into that crash. So you're saying BOJ raising rates by 100% could have the same effect as JPOW cutting rates by 50%? Roughly, yeah. Well, Bank of Japan did. They did make a rate change, and this is what everyone has wrong. Bank of Japan raised this week their yield curve control policy on the 10-year note from 0.5 to 1.0. So they did raise rates effectively. They created a range of possible tightening. Yield curve control policy doesn't work exactly. There's a lot of argument that the Fed should use it as well, but we don't. Hold on. So see, when yen becomes the most worthless, and then when that spread collapses, crash. Yen becomes worthless, crash. Yen starts becoming worthless, crash. I could do this all day. This is fun. Yen almost crashed last year, but it's starting to become worthless very rapidly again, right? The daily candle on the Japanese 10-year is awesome. Yeah. FOMC stated they don't see a recession on the horizon because it's going to be a depression instead, right? Okay, first of all, the FOMC did not say they don't forecast a recession. It's still part of their last data set that they publicly issued. JPOW said he thinks maybe we could get a soft landing, possibly, if nothing changes. That turned into a CNBC headline Fed doesn't forecast a recession. They're two very separate statements. FOMC is a consortium of people who, much like economists, are just following the trend and extrapolating it forward. Yeah. Is there a way to reduce the loss on something with vol decay like SQQQ, or would it make sense to hold the bags for that rapid breakdown correction? I mean, no, it doesn't make sense to hold the bags. You can't offset the amount of loss that you could experience on vol decay, especially if the risk off behavior continues, right? Did they officially do it, or did they give themselves the flexibility to do it? Well, it's not flexibility. It's up to market participants. What they did was they raised the cap from 0.5, which gave you a 0.0 to 0.5 spread, right, to 1.0. So now the yield of the Japanese 10-year bond has more range and with which to fluctuate, but market participants can pin it to 1 and force Japan to continue to do quantitative easing until they run out of money. At which point they would have to increase the yield. So you could go short Japanese treasuries, right? Pump the yield and then force the Bank of Japan to increase the yield. And that can just keep compounding, right? So the Bank of Japan effectively opens up this play by increasing that range so much. Which is going to incentivize people to go long US treasuries. And that's, so that means that by Bank of Japan doing that, they're incentivizing the counter trade to the currency carry trade. Because if you go short Japanese treasuries, long US treasuries, you're going to pump the yen, drop the dollar. But by doing that, they're able to reduce their inflation, right? Because the value of their currency goes up, the buying power of that currency increases, and that narrows the spread between their producer inflation and consumer side inflation. I know, it's got, like I said, it's got a shitload of moving pieces. But basically, at its core, banks are taking shitty US securities that the DTCC haircut them on and will no longer allow them to use in the US to Japan. They're getting leverage. They're reinvesting that capital back into the US at an massively increased amount, right? You put 100 million in US treasuries and deposit at the Bank of Japan, right? And then you're getting leverage on that capital in at whatever rate they're currently allowing leverage, and you're leveraging up those funds and then lending those funds into the US. So if you get defaults in the US or the Bank of Japan raises rates, because you're essentially borrowing that leveraged capital on a variable rate loan, right? It's a variable rate line of credit. It shouldn't be, because Bank of Japan's never raised rates before, right? So there's always been safety in that, but that safety is deteriorating. And Bank of Japan's loosening those restrictions, right? And that means that the risk is starting to come from both sides now, right? You have an overinflated credit bubble in two places. Thank you, Nuns with Guns. I appreciate it. Okay, so yeah, and I was gonna probably have like answer some questions and then see if Dork and JFresh want to hop on and add their pieces of this if they have any. I don't know if they've got time to think about it yet, but you definitely need an ISDA or you need to be an international bank. Is Yuta gonna get disappeared? No, but I understand why he's nervous. If SPX nears the JPM collar, does that pull the SPX higher? Not really. It's so close to Gamma Max, it looks like uncharted territory. I don't really think we're going up a lot more here. Gamma Max is just climbing because so many out of the money calls are being sold right now. Like this Friday's bounce back. That wasn't like bullish. That I'm not really sure anybody actually made any money off of that. It was mostly just exiting of at the money and slightly out of the money long positions. An effort to close those equitably. Could the yen possibly be used as a leading indicator in this case? Or there are too many other factors involved? There's way too many factors, but it is one, yeah. I don't know if it'd be leading or just concurrent. Just pumping the yen, dropping the dollar work in a leveraged manner? I mean, it can, yeah. That can start to get leveraged very, very rapidly. Thank you, Nuns with Guns. Can I leverage US Treasuries in Japan, or do I need an ISDA? Will Todd's beatings increase from here? Hopefully. Well, someone's out, right? So that means I don't know who, right? But someone got the fuck out of that trade fast last week, and the market recovered, but not all of it, right? We dropped 170 BPS, and we moved up 100 of that on Friday. Um, Shitloads of out of the money calls blew up almost instantaneously. There was no liquidity to exit those positions. Tons and tons of money was lost just on the rumor of this shift in policy. And then within 24 hours, we had, bearish positioning on the SPX, which, like I said, we haven't had in a while. Yeah, it's not retail pumping the stock market. With these macro developments, what are your thoughts on BTU? Mainly, could big downs ruin a commodity supercycle, you think? Or is one a byproduct of the other? I mean, commodity supercycles are generally started on the back of economic recovery, right? As governments begin to subsidize economic expansion, universally. So, EU, US, Japan, China, all of them at the same time, subsidizing expansion creates huge amounts of demand on commodities. Right now, commodities are still relatively cheap. So the index effect, I think, is less relevant. I mean, they have to, right? Like, they're not going to just say no. Basel III requirements are going to probably significantly change the risk profile for international banks. That's one of the reasons they're so resistant to it, is because all of these banks technically don't have any money, right? They've just leveraged up all their money and relent it in the US to try to get their net interest income higher. Meanwhile, they should be contracting lending at a rapid rate. And so what we're kind of getting is, like, we had a bout of inflation due to supply chain crunch and, M2 supply increase. But what they're creating is we're creating a bout of we're creating a new bout of inflation due to over lending, right? Because lending's so incentivized and they're doing it, you know, against this spread. Um, Let me think of a way to put this. Yeah, we're creating a bout of inflation due to over lending and currency value destruction, right? Which gets blown up by bank rate increases. And so these banks are fucking broke, right? They're just leveraging assets they can't mark to market in a different environment. Is there limited up range? Does that mean 1 to 2 or 1 to 5 to 2? Put call make most sense for straddling. There's not a ton of range to the upside right now. I mean, the call ladder largely broke down. There's still some interest at like 4,600, but for straddling, I mean, 1.5 to 2, it makes sense. Yeah, we're really pressuring the upside. Remember that the higher we go, the more reduced the like returns are, right? So, um, you know, that the effect of those diminishing returns kind of caps our upside. That's why we keep failing at these like crazy high tests and then like have to test them and test them and test them, because if no new buyers come in, then there's nothing to support the range and it collapses. And people don't want to buy any of this shit. I think you'd be hard pressed to find an investor that's like, I'm buying Nvidia at its current price, right? Or Microsoft or Apple. And when the vast majority of market participants have moved to the sideline because, you know, they've created like that so part of that risk off scenario, right, is they've created that kind of bubble at the end, right, where their equity value is so high that there's no buyers, right? You can't find buyers, and that's where the loss occurs. Because equity values have massively exceeded their actual value, right? We probably won't see inflation hit CPI, PPI for a few more months, right? I don't know. Gas prices have stayed pretty steady and high through July, which means the August, September print. It's a, yeah. Can you speak to what the plunge protection team actually does versus the RSS tinfoil? I mean, it's moderately secretive. I mean, they have some power to stabilize markets and prevent a collapse, right? So in the event that the market is going to collapse, they can do things like push forward, you know, restrictions on short selling. They can the Fed can move into the market and buy equity securities, and you know, that kind of thing. But and they're it's a tool to prevent a total collapse and reduce panic. But it's not like, you know, they just, oh, the market's dropping, let's pump it. Well, the subprime lending crisis is building now because US banks have gotten these leveraged funds, right? And the interest rates are high. So now they want to lend to anybody who will take it because they need to lend those funds. Otherwise, they're losing money on the interest owed to Bank of Japan, right? So if you want to buy a car at 7% or a house at 7%, maybe that house is sight unseen, uninspected, and you're getting a cash loan that you eventually convert into an asset backed loan down the road. I mean, this is all going on right now. So this is working kind of inverse to the way it did in '08. Partially because of the participants, right? In '08, hedge funds were going to Japan and getting leveraging up assets in order to buy mortgage-backed assets in the US because there were so many of them, right? But this time it's the banks that are going and using the funds to create mortgage-backed assets, right? Have you heard of the investor who goes by the name Tom Lee? Please remind everyone that after making all of us so bearish that we can keep pumping. Oh yeah, I mean that's like a big part of it, right? Because they may now have to risk off more of the trade. And if they risk off more of the trade, that means more ups. Or they're done. And that's why it's not a good tool to assume a time horizon. Because we did just have a very significant change in the spread last week. So running out of greater fools, yeah. I mean, you need someone to buy, right? Otherwise you can't sell to them. That's why all these banks are upgrading these fucking companies massively beyond their 10-year earnings like potential, right? You've got Schwab and JPM and Citigroup and Deutsche all coming out with these fucking analyst upgrades that are like 100% of fucking potential profit on sales for the next 10 years. And they're ridiculous, right? But by publishing those upgrades, they're, attracting buyers. And mutual funds can't buy this shit unless there's, a valid case for them being this overvalued. And once you start to exceed the value that mutual funds can legally buy this shit at, you start to run out of buyers really, really fucking fast. Poopy Pants could probably weigh in on that. He works in that environment a lot more than I do. Oh, okay, Dave. Thanks, bot. Joke's on you. They're just pricing in 100% inflation. Well, the fun thing about this, oh, this is the last fun piece of the puzzle, is by doing this, you'd be creating a ton of money velocity, right? Like the M2 velocity should just be blowing up. And when I wrote the DD, we hadn't had the M2 report yet, but now we do, right? And what's so fascinating about this is M2 has increased quarter over quarter at the fastest rate, I think, in the history of tracking the M2 money supply velocity. Because what you're doing is you're taking U.S. capital, you're depositing it in Japan, you're creating capital in Japan, which you're then converting back into the US and loaning here. So for every dollar, you're creating all of these fucking transactions, winding the leverage currency back to the market that it's being transacted in, right? And so you're also increasing inflation by rapidly increasing the rate of money velocity. And then, yeah, like a day later, we got the M2 report that showed that it had been increasing at a very, very fast rate. Something in elastic market flows from that 99-page paper you put in the Discord. Yes. Okay, so with the BOJ raising rates, causing an international credit crunch that has yet to be realized, and overinflated asset prices, etc., wind down. Well, as soon as it's unwound, probably. Because the last step of that is selling securities. Selling securities to, pay back the Bank of Japan. And once security values start dropping, that creates fear, which makes other participants want to sell securities that they bought at prices that were too high. And that creates more fear and more fear and more fear and more fear and more fear, right? And it compounds. I only have till June 16th on my puts, though. Popcorn Trader, I've got to tell you, man, it's July. But I guess what I'm trying to say is the clock is in motion. I wish it gave us a tighter timeline. But I think it's important to understand the the data supports that this is happening. What are your thoughts on semiconductor ETFs as a 5 to 10 year hold? Have you listened to anything I've said over the last hour and at all? Probably better than cash, but I don't know how much better. No. No, not weekly puts. Not weekly puts till we're under gamma neutral or delta neutral. There is no reason in our current range to take on that kind of risk. Intraday puts, if you're playing a small breakdown, yeah, but weekly puts are just really bad, especially if they're outside of our current trading range. I mean, the best way to handle this is to play it day by day until a breakdown begins. And yeah, you might have to pay a little more for your puts then, but it's better to have the confirmation. Yeah, no problem, Barius Aquarius. I hope I was able to get it across in a way that at least enough people understand that they can help others understand it over time. If I could get on a major news network, I would definitely push a more refined version of this DD, but how make money now with trading trades? Yeah, trading trades is a way to make money. You should pick a trader of the day at the end of every stream, even if it's you every day. It's definitely not me on Friday. I made $60 on the stream account. Although I did make money. It was not a lot. All right, let me see. Do you have any question about any stocks? Because I know we didn't really get to any of that. With me kind of going over all this. Would you finally promote the channel if you got on TV? No. How about 6 months at the money bear put spreads? For the first 3 months, they have negative theta decay, meaning they gain value as time goes, and hedge with short dated calls. Yeah, you can. Yeah, you can use spreads. They are the profit on them's limited, but yes, you can. 1,000 BPS overnight drop is not possible. It's not that it's not possible. It is. But holding those puts will probably cost you a lot more than... Well, I mean, if they're hedged, then you don't have to worry about it. You can maintain the exposure, and if an unexpected drop happens, you can capitalize on it. I mean, that's largely the position I have, right? Is just a hedged long short position, but if it's unhedged, absolutely fucking not. How's A, B, and B looking? Well, I didn't like. I mean, I got stopped out of it on Friday. I didn't like the range it was at. If it fails this test and back through 52, I might re-enter. With the indexes being so erratic and A, B, and B now having higher weight in NQ, I kind of just want to stay away from it for a minute. Um, and kind of see how it repositions. I might even wait till after earnings and just like short a continuation or long a continuation. They could get rejected here and fall back to like 150. So if you entered, in this upper range, that's not so bad, right? Thoughts on NVAX as we move into a slight Corona uptick and it being heavily shorted. NVAX. God, which one is that? Was that the shitty, like, Steve Cohen trade? I don't remember. No, that was something else, right? Are we seeing a big uptick in coronavirus? Hmm. Yeah, I don't know. I don't like going anywhere near biotech. I don't care about it. What's an LNC tanking the market? Why? Why LNC though? Out of all the insurers. Mossy? I never got a chance to look at it. I knew you were going on about it. Got it at 111, sold at 120. Okay. I mean, a medical device maker. Do they have earnings coming up at any point? What was the sell-off due to? Seems like they've had pretty consistent sell-offs since like April. Or December 21. I mean, the longer term you look at this, the worse it looks. But yeah, I mean, it may continue to see price improvement. I don't really care about the gap. It looks like it doesn't really need to fill those every time, but maybe it will. Big put flow on INC. That makes sense. I don't think anybody's expecting very good earnings out of Intel, although it may not lose enough value and there may not be enough volatility carryover into the crush for it to be worthwhile. I don't like playing earnings. Maybe I should make that really clear. Can you please make this stream so that non-members can view later? Seems important enough to make sure friends and family understand. Thanks. Yeah, yeah. It's always like that. I think it should always be available. What's the current outlook of GME given the macro conditions, lack of options interest, CFO resignation, etc.? Uh, I mean, it's actually being shorted for a change, and that accumulation has been decent. It'll probably continue. There's definitely still more liquidity to short with. Um, Obviously, some liquidity is being offered up by investors that are losing faith in the direction of the company. Um, as a business, I mean, I don't think Cohen's done anything impressive with it in the last 2 years. So unless that changes, interest in shorting it is only going to increase. If you look at Rocket and UWMC, both have been on a strong uptrend. I'm unwinding my long positions. I'm wondering about upside range. That's the wrong one. RKT. I mean, Rocket doesn't look particularly good. Although I guess see how this plays out. Your downside risk is around 1050. Resistance at 11. So I mean, yeah, it makes some sense to take profits here, especially as this broke down instead of continuing. Right? Had this had a continuation, obviously it'd be a lot more bullish. But this breakdown's pretty bad. So I'd be watching like the 1075 level next. UWMC. It's been a long time since I looked at that one. Pretty consistent rate of growth. I mean, if institutions are trying to lend more, they're a wholesaler, so it makes sense that they'd continue to grow. Fubo still looks like liquidity is contracting. It got a little bit of a bounce, but I feel like that's gonna get probably stuffed. Uh, it did hit my downside target, so maybe it won't. Earnings is pretty close. We really don't know how those are gonna turn out. If they continue to meet their goals for profitability, I expect the range that Fubo is trading in to probably move up. We probably move up into like the 3 to 390 range. So if you're long on the stock, obviously be aware of that, because yeah. Siri recovered $5 on Friday. Liquidity's still declining. The liquidity gained in after hours was pretty unimpressive. It looks like on the liquidity side of things, we're seeing consolidation both in the underlying and in secondary market liquidity, right? So that's contracting, which is arguably bullish because it means they're running out of liquidity to short with. And it's back above the $5 strike where things get spicy. They do have earnings and a dividend coming up as well. And if they're short fucking, down at like, if they're short down here at like 338, the dividend on yield is more significant, right? Or the yield on cost is more significant. Yield on cost. I knew it? Knew what? Who's price anchoring? McCuller? Please make the stream so pigeon whales can only say fuck the pores, because I miss those days. I miss being poor. He'd worked so hard for the chance to take my money versus now being shadow banded. How are you shadow banned? Chinese EV has been going very well. Yeah, I don't care about NEO or XPEV. Chinese auto sales have fucking bottomed. They look like shit. I don't want to invest in either of those companies or trade them. I've seen you going on about NEO. I've just ignored it. Chinese auto sales were down 80% year over year and then like 20% quarter over quarter. And the trend doesn't look like it's reversing yet. Thoughts on Tesla failing to bounce back as high as much of the Mag 7. Entered a 260 put for 818 Friday. I'm thinking it looks weak. It's starting to look pretty weak. It's obviously finding resistance on the downtrend here. A failure of 266 is probably bearish, but there is some consolidation to consider. So the range may not be that great. I think the sell off stabilized a bit after their unimpressive forward guidance and giving away $1 billion to try to pump up their or prevent bond downgrades probably. But yeah, I mean it still looks weak, but you probably wait for interest to reaccumulate after profit taking occurred. I don't think there's like a rush to get into it. An NFT dividend? No, it's like a 2-cent dividend. It's 2%. Fubo's shouldering my port at the moment. Cost basis of sub $2. CCs are small but steady gains. Yeah, the yields on them are pretty good. Also, I didn't realize Fubo was $75 a month. That was a shocker. Fuck the pores. Yeah, it's pretty pricey. They're working on that, and maybe this quarter we'll start to get some guidance regarding ad supported subscriptions. I know they spent quite a lot of money testing them and planning for them. So if they roll those out, that could increase the subscriber base substantially without reducing the per subscriber like net income. Your thoughts on Beyond's long-term prospects? It's tough. They are both. Me and Dork had this discussion pretty extensively the other night. They are both consumer discretionary and a consumer staple. Um, I think they'll always have a customer base, regardless of how many how many years the CEO collects. Um, but the better question maybe, are they the company that is going to receive the majority of the market share? And that, obviously their management has not done great so far. Not that they can't improve or do better, they could, but the management is definitely a point of risk. The lion's share? No, I wasn't gonna say that. Witness me. I see you, Balani. I'm not ignoring you. Don't worry. Do you mind talking about the end of day credit spreads that are in the money where the payout is over 50%? I know it's high capped risk, but curious on your approach to that. I mean, you just set limit sells and see if the demand for liquidity fills them, right? They're selling options all day. And then you're selling them to them when they need to close them out at the end of the day. So sometimes those spreads get really, really wide When they're trading like tens of thousands of contracts over a few minutes, right? And yeah, so sometimes you can get some pretty insane fills with fairly low risk. I know me and Jay Fresh have both gotten some that should theoretically not be possible, but they are, because the amount of liquidity and interest in the strikes is just something to behold. Hey, it's Dork. Hey,
What's
Dork.
up? How you doing?
What's up, man?
Just hanging out, clicking on stuff, listening to you talk about things that make me excited. How are you doing?
Pretty good.
So, um, if you look up at the general chat, the first two charts I posted were pretty relevant to what you were talking about with the whole Bank of Japan thing. Just to
Oh,
sort of,
okay.
I just
First two, the Fred charts, right?
yeah. The
Okay,
first one I think is the most relevant,
okay.
um,
This is the
because
FHLB side of it.
yeah, exactly. Because like I think it's important to sort of put this all into perspective, sort of in terms of how the banks are really doing as well on their deposit side.
Okay.
So the whole Bank of Japan free margin machine, it's not really free, but you know what I mean, like the cheap margin from Bank of Japan,
Yeah.
uh, it can be used for lending, but it can't be used to cover deposit loss, right? And needed liquidity to make people whole on their deposits when they pull them out.
Yeah.
Um, so the FHLB is sort of like uh, the Fed, right? It's the lender of second last resort, right? It's where you go when you don't want people to know that you're fucked.
Yeah.
And as we can see from this chart, that the amount of total assets held by the FHLB, aka loans on their books, is higher than it was in 2008, and it's going up at a hell of a clip. Um, this data hasn't been adjusted for Q2 yet, or it hasn't been released for Q2 yet, so we have yet to see if it's continued upward. If it has, that's nuts.
Yeah. Yeah, I agree.
Um, but this just goes to show that in terms of total deposits by the banks, their actual real liquidity, like you were saying, they're dirt poor. This really does show you how dirt poor they are, that they're dipping into this FHLB system to get their liquidity to make their depositors whole when they withdraw.
Yeah.
So, and the second chart kind of piggybacks off that to sort of show the relationship where money is flowing out quickly. The acceleration that we're seeing is it's no longer base effect from 2020, but the acceleration is the most rapid that we've ever seen in the velocity of M2. So it shows that this depositor flight, is having an effect on.
Ooh,
Uh,
I have a M2 velocity chart.
for sure. If you get a better one, then by all means.
Oh, I don't know if it's I didn't did you post one? It's the
Yeah,
same
I did.
one. It's
Okay,
yeah.
yeah.
I had it. I had it also.
It's an interesting chart. I mean, overall money velocity is still low, but it's definitely increasing very rapidly. And I'm not exactly sure if a mean reversion back below zero is going to happen. Uh, at least not in a little while, thanks to the whole deal with what's going on with commodities, which I have more charts below to
Oh,
sort of explain why I think we're going into a commodities cycle and why I think it's driven by the currency markets rather than say demand for energy.
okay.
Um, but anyway,
So
so
do you want me to go to the first one of those?
the monthly or the very bottom one I think is fairly telling.
Okay.
But really, you have to kind of hand wave a little bit in the explanation, which kind of sucks, but it makes sense, right? When you think about what's happening with these FHLB loans to banks, you think about the popularity of this Japan trade, um, and you think about the velocity of M2 money stock. It sort of explains why oil has sort of bounced over the last month. because over the last month we saw Dixie really show some true weakness. Actually breaking that $100 mark.
Yep.
Before bouncing back, but it still broke and it hung out there for a little while before reversing. So what I think is happening, sort of on like a zoomed out scale, is in terms of inflation, we've seen um, oil prices get suppressed by our president Joe Biden through selling from the SPR. And people just, not really wanting to buy oil while he's selling into it, right? I mean,
Yeah.
even though buying oil into dropping prices is kind of a smart idea. Um, but with the SVB failure and the subsequent bank failures, the Fed continuing to raise rates, inflation, especially core, being sticky, I think what we're seeing is a wavering confidence in dollar markets, mainly treasuries.
Yeah.
That's had an impact on the value of the dollar. And with that last chart, what I'm trying to point out is, one of the last times this happened was post .com bubble.
Yeah.
Confidence in the dollar really dropped, and there was a lag effect. But what ended up happening was it kicked off a super cycle in oil prices, and I think it was just commodities in general.
Yeah.
And this is sort of like a lagged effect of the money market on the price of commodities. And I think we're seeing another one of those sort of wind up
Yeah.
currently.
I agree.
So I remember
Another thing that you could look at, hold on, is here with like, maybe a better view of broader commodities than just oil is
you want to
something.
hide that. There you go. Cool.
Yeah, I've been watching this for a few weeks now as it slowly builds into a recovery. But if you compare this on the weekly, right, against dollar value.
Yeah, there's a nice inverse relationship that shows up every once in a while.
Yeah.
It's it's definitely interesting because it's not always there. There's a good amount of positive correlation in times, but when the inverse relationship shows up, it does tell you that there is some sort of effect from the currency trade on the commodities market, or vice versa. But I
Well, it's
generally
it's
think
also
more.
it's also broader, right? As currency values decline, inflation rises, and that breeds recessions, which breed government stimulus to bring currency values and economic growth back in. And government stimulus tends to lead to high demand on commodities. Something we were expecting to see from China earlier in this year, but are now going to see slowly bleed in over time as China's recovery was kind of hamstrung but hasn't been stopped, right? And then, but this could be years in the making still.
Yeah, yeah, exactly. And that's kind of what I'm trying to. I mean, and this is once again like to put. I'm trying to sort of put a rough time frame on sort of say when there would be some sort of financial event. Even though getting out of the currency trade last Thursday was a big deal, in terms of how long this could take, if it is really purely based on the currency trade and not some sort of credit crunch.
Well, the currency
Uh,
trade begets a credit crunch.
right. And so if there's no underlying events that tighten credit rapidly beyond the currency trade itself,
Yeah.
this could, if it kicks off a commodities cycle, it could take, it could take up to like a year as oil prices just go higher and higher, right? And if they revisit like $100 a barrel, right, that's when we should start sort of having the alarm bells go off that there's something wrong.
Yeah, I agree. And I don't think $100 a barrel is out of the question. Although I'm still targeting like 85 to 90.
Yeah, once
It
again,
could
in a
just
1 year time
expand even more rapidly.
frame. Yeah, I'm saying in like a 1 year, almost 2 year time frame, you could see oil going back up to 100 over that time frame if the commodities cycle starts, and if the dollar index keeps dropping along the way, then we know something is up.
Yeah.
Hey,
Well,
Japer.
if the dollar drops even more, then that that generates even more risk in the carry trade, right? Because remember, you get squeezed from both sides on that.
Yeah.
Yeah.
And that's how, and once again, that's like the rise in oil prices would be almost like a symptom of that underlying trade sort of breaking down.
Yeah.
Don't worry,
So,
guys. Biden can just sell from the SPR. He refilled it, right?
Nope.
so.
No, but he did.
Man,
He did sell at a good time.
yeah, and he kept selling,
Yeah.
even in the range where he said he was going to refill it. He only had 4 opportunities.
Well, those are mandatory sells. So there's always like an ongoing mandatory sell. I think part of it's to continue to fund SPR infrastructure, and then the other one is to like rotate the reserves. But those are continuous. The majority of selling he did when oil was peaking previously.
Yeah, yeah, I know.
Excellent trader.
The problem is that oil's going to peak probably again, and he didn't refill when he had the chance.
Yeah.
In order to
The
probably
when
in
he
order
had,
to avoid creating inflationary pressure, right?
right, when he had the 4 chances.
Yeah. Well, yeah.
Yeah. No, that's definitely not going to come back to bite us.
No, totally not.
What are
It
you guys
did
talking
it
about?
didn't in the
Commodities?
70s, right? Nothing went wrong there.
Remember how nobody cared about commodities for like the last 4 months, and now everybody's talking about them? It's kind of
Yeah.
cool.
I cared.
Everybody gave up on the pain trade, you know.
I
It
was
was. I
buying
mean,
them.
what's his face from Morgan Stanley was super bullish on commodities for a while then, but then oil just kept going down and down and down, and so he finally capitulated and went, I guess oil's just going down.
That's the best Warren Buffett lesson ever, right? If you think it's cheap, it can be cheaper.
Yep.
How's Nat Gas doing? I know you were saying for a long time, just
little,
keep going down.
yeah, a little bit better. Hold on. Oh, by the way, this is starting to break down. Just
What's this?
this is the implied correlation index versus the SPX for VIX. That's kind of like what you measure.
Implied correlation being
I sent you the white
between the
paper.
SP. So is it just a correlation between the SPX and the VIX, or is it the correlation between SPX and the underlyings?
SPX and well, the correlation index is for the VIX.
Okay, yeah, I'd have to read it. I didn't read it. That looks cool.
It's the end of day implied correlation index. It's a gauge of herd behavior, and it measures the average expected correlation between the top 50 stocks and the SPX index. And then they calculate core 3M using at the money delta relative to constant maturity SPX index and component option implied volatilities.
Ugh,
That's kind of cool.
So if all the like it drops, if all the volatility is moving into stocks, right, and it goes up if the volatility is moving into the index itself.
yeah, I mean, I think that's
so
pretty
it's
clear,
it's a
right?
good way of looking at VIX shorting. And you know it would infer that we're seeing or imply that we're seeing the largest VIX short in the history of the market, even more so than from 2016 to 2017.
Yeah, but I think from this you can kind of infer what Kinney's strategy is and how he makes money. He's just doing dispersion trading, right? Because
Yeah.
the correlate, and you could probably figure out which one's long or short. I have to think about it, but the correlation goes up in 2022, or the measure of the correlation, and he makes a bunch of money, and then it goes down and he makes a lot less money. So he's long the correlation.
Yep.
But yeah, when's the last time it was this low?
Never.
Of course.
Love it.
Wow.
Yeah.
Whoa.
Yeah, we just exceeded Volmageddon by a little bit on the 19th. That's the beginning of SLD.
Hmm. So if we had the capital and infrastructure, we should go long dispersion. We should go long SPX vol, short. Well, how would that work?
You would go long SPX, short the top 50.
Yeah, but I don't know if I
Long
want to go.
SPX vol, and then short the delta of the top 50.
Yeah.
Yeah. So I don't know what's the most heavily weighted ETF, but there's probably one.
Just waiting on something to break. It's all
Yeah.
ready.
Where's
Everything's-
my SPX 5 ETF? Or 10? I'll do 10. I want to short the SPX 10 or the S&P 10, and then
So you want
long vol SPX.
So you only want to short 60% of the SPX?
Yeah. That's the 60% I want to short the most.
I mean, you could just go like long SPY, short the SPX 10. Be a hedge trade.
Anyway, you were saying something else too before I interrupted you with the fund dispersion stuff.
Me? Oh,
Yeah.
we were just talking. I was just talking commodities. I just think
okay.
it's quite interesting that, I mean, everybody's still kind of, celebrating that inflation's coming down, and I don't think anybody really recognizes that it's already starting to reaccelerate. And actually, I was looking at this earlier today and recognizing that, and perhaps this is obvious, but oil basically follows the SPX lagged by like 4 to 6 months. And so it's almost no surprise, right? As people get more exuberant, they pump money into risk and they start spending money, which causes demand for everything to go up, which causes commodities to eventually go up. Because I think a lot of people were short commodities and things, just because everybody expected a recession. And I think that's probably unwinding to some extent. I haven't followed commodities very closely, but I imagine those need to be squeezed too. I mean, we're kind of getting to the point where like the big indexes already got squeezed, and so now we're like squeezing all the random stuff. Like meme stocks are starting to squeeze a little. We're almost out of shorts.
Which means we're almost out of buyers.
Right. Yeah, shorts are just future buyers. If you force all of your momentum aid out, then it's just you versus you if you're long.
So nat gas is maybe not dying anymore a little bit.
It looks kind of nice.
It's been a hot summer.
It's been pretty free to have a bunch of natural gas, and it's becoming less free.
Well, I'm certainly not a meteorologist.
No.
And there is.
Do we need a meteorologist on the quant team? Or just a hot weather lady?
Same thing.
Okay.
Well, best win both.
Yeah, best win both.
Find a hot weather lady that is
also a meteorologist.
A great meteorologist, a very competent one.
Shit.
We just get Carl.
Yeah, what about Carl? And just put him through school.
Make him scantily clad in front of a weather chart.
Hot short pants or like really tight dresses.
If he looks like the picture, his meme, then sure.
Okay. He does. I've seen him in real life.
Anyway, the meteorologist stuff. So Europe's been cool this summer, like quite cool, like significantly cooler than expected. And if that translates over to winter, which it doesn't necessarily, that's like not how the weather works, but if it is a cold winter, right, then nat gas could be quite the pick. It's extremely cheap right now if Europe has a cold winter.
It's a hell of a speculation play. Which I
Oh,
think
yeah.
is what we're seeing in the increase in price, because like natural gas cost hasn't really gone up, but we're definitely seeing more speculation on Henry Hub futures here.
Although, like, energy companies are still not doing very well. They could definitely use a little bit of a boost in price. I mean, they can't just keep taking losses forever, can they? Don't know much about the energy sector, but
I mean, they just had a phenomenal year, right? So
yeah,
they're fine, largely. Exxon's earnings were pretty good, even though they took a hit.
I don't know. We'll see.
Yeah.
I think Schlumberger just had their earnings too, and I think theirs were kind of ass, if I remember correctly.
Well, they don't extract oil; they just do refining and stuff, right?
Yeah,
Or
they're
they
like
sell,
they're like
sell the
they're like Halliburton.
yeah. They even probably more so sell the infrastructure to the oil industry.
They
Yeah.
do, but that's kind of telling as a forward-looking indicator.
I don't know.
Yeah,
Halliburton did really well, so it could just be that they're losing market share.
True.
Maybe.
True. Oh.
What
Yeah,
so what are all the kids in chat interested in? What are they talking about today?
They want to know
Just,
when Japan when puts
on everything. I mean,
yeah,
who knows?
when SPY put print.
Yeah, when SPY put
I
print.
figured everybody would just be whining about their Siri calls.
I've been eyeballing 24 4,000 leap puts. They're only 4K. I'd like your thoughts on such a play given the BOJ situation thesis. Jan 24. I mean, that's 5 months. It may not be sufficient.
Yeah, that's a big move. Why would you go that far out of the money when you could get closer to the money for the historic? You get like 5% out of the money for like the cheapest it's ever been.
Yeah.
Yeah, seriously, crash protection these days is like so fucking cheap. It's just been ground into the dirt. It's
Yeah.
hilarious.
It's very cheap. You could go further. You could go 25. I'd rather spend more on a option for 2025 that I think had a higher chance of printing than save a little money and get more leverage on Jan 2024. Not that I think we necessarily have beyond Jan 24, but I mean, just from a risk assessment standpoint, I think like having more theta is always better. Or you could sell debit spreads. Ooh, what if you went like September 3,800, Jan 2024 4,000, like short long.
That probably looks a lot better.
Yeah, I would imagine that looks a lot. It's also cheaper. You get a lot more leverage for way less money. And yeah, if it crashes in between, then whatever, you still make 20 grand a contract.
I like it.
Actually, that sounds really good. I might pick one of those up this week. No, I mean, so like when is it going to drop? I mean, look at the market; it's going straight up. So it's hard to say that. Barring any like.
I mean, I think we'll have
catastrophic
at least
incident.
some confirmation. You know, something's gonna catalyze this. If the catalyst started last week, you know, and we fucking start moving down 3% this week, we're gonna hit those levels, no matter what. Right? We're gonna hit gamma neutral. We're gonna hit delta neutral. You can increase leverage after you're already right, instead of trying to pick up all the leverage when you don't know if you'll ever be right.
Yeah, I like that better. I mean, the fact that they were able to completely reverse the craziness from Thursday. I mean I mean the amount of aggression there was pretty extreme. So I mean
But they
it's
didn't really make any money doing it, which leads
no
me to believe that maybe they're still just pulling back rather than going more
it's
long.
yeah it's really hard to say.
There's a lot of out of the money calls being sold.
I would imagine there's always a fair amount of out of the money calls being sold.
Well, Dalton Gamma Max has been skyrocketing. So maybe a few more than usual.
Yeah. I don't know. I mean, I've been kind of trying to piece together, the whole story. And I was listening to somebody talk the other day about, their soft landing argument, and I followed it most of the way. Right, you had a supply shock from the
Yeah.
coronavirus pandemic. Okay, follow you. Then you have wage pressures now, but the supply shock is easing. But now we have sticky high wage growth, which is kind of an issue, and lower productivity, right? Which is key. Most of the
Yeah.
economists and people who are bullish on wages going up and GDP going up are ignoring the drop in our productivity is still going down year over year. It's decelerating, but it's still going down.
Yeah.
And so you get to that point, like, okay, I follow you. So the end result is, eventually this will collapse because we're just pumping money after lower productivity, right? So eventually this has to reset, right, and renormalize to that lower productivity output. But no, then the soft landing argument is AI will improve our productivity immediately and to
Yeah,
great
no
degree.
one
So
liked it when Zuck said that that's not how that's gonna work.
yeah, well, I mean, that is the soft landing thesis,
I
right?
know.
It requires a massive growth in productivity to match the strong wages and strong labor market, right?
AI
You
doesn't
can't.
even have infrastructure yet.
Well, I didn't say it was rational, and that's kind of where we
Oh,
get to going back to, like, when is it going to drop?
yeah.
You're dealing with people who are buying a vision that doesn't exist, right? And are willing to buy it without any due diligence on the credibility of it, right? I mean,
Like
no.
superconductors? Like
I mean,
room temp superconductors? Everyone's getting
that,
real bullish on those all of a sudden, even though that
it's
paper
just
has not
it's
yet
too
been peer
soon.
reviewed.
Yeah, it's too soon. Um, they also there's issues with that superconducting material. One of the issues is that it really can't withstand the really high
Amperage?
mag- like magnetic fields that you would see in something like a fusion reactor, right? I mean, people are really crazed about the future, the prospect of room temperature low pressure superconductors is that you could really start to get some of these tokamak reactors to start working pretty efficiently. But they're huge magnetic fields, and it's not superconducting in those magnetic fields. So at least fusion's out on this material. I mean, you could look at like energy transport
Well, we don't really. I
but
mean,
we don't really
I
need
read
that.
through the paper, and I don't think there was really enough information there to say if it could scale or how it would scale.
Yeah, I
But
mean, yeah,
the
the way that
amperage
they
limits before you lose superconducting capacity are pretty low. It's like 260 milliamps
well
at
that
like 295 Kelvin or whatever. And then
well
like
that was
it just
a
rockets down the more energy you pass through.
I mean, that's one of the biggest preliminary things missing from that paper is they quote the amperage, and if you're really being truthful and you want to allow for a robust comparison to the large library of superconducting materials that are already out there, you need to quote the the current density, which is the amperage divided by the cross sectional area, effectively. So since we don't know what the size of the conductor was that they were using, I mean, you could be talking about such low current density that it's useless, right?
Yeah.
So they're definitely. Basically, people are jumping in on everything way too early because the exuberance is just through the roof.
Never go up.
I personally don't understand it. I would assume this is just because it's easy. Everything goes up. Just put your money in. It's kind of like 2021 again. but I don't think that this kind of behavior would have existed, without all of this money sloshing around. Like the fact that no analyst in any of these earnings with Nvidia or with Microsoft or with, Meta, Google, they are maybe starting to be a little bit more critical, but people trying to ask like, what's your capex like, and what's your return on it? What's your expected return on all this capex, right? I mean, like Zuckerberg is losing what, like $13+ billion a year on the metaverse, and it makes no money
Yeah.
for years now. Like how many years is that going to happen in AI, right? I mean, they're spending all this money, sure, but are they actually going to be really making money, right? What's the business case? And
Yeah, I agree.
and I feel like nobody's asking that, right?
Nope. Definitely not the guys in the earnings calls.
And I don't know. I haven't listened. I've only listened to maybe 30 earnings calls, right, since I've started really trading stocks.
Yeah.
But I mean, I really liked Upstart's earnings calls because I feel like they asked a lot of questions about the business, and then that there were very few buzzwords. There were some jargon from the industry, but they talked in ways that were concrete, like
Yeah.
with answers that could be analyzed independently, not just like, oh, we're really, anytime I hear like the top 10 companies on their earnings call say, someone asks a question about like their returns or something, and they start with, we're really pleased with. It's like, your pleasure should be irrelevant to this. This is a mathematical equation. We want the solution to, like, how pleased you are with it should be irrelevant, right?
I'm
But
interested
and
in... Oh, sorry.
they
Go
get
ahead.
away with, sorry, I'm just gonna say, they get away with so much, and it drives me nuts that people let them do that.
I'm interested in JFresh, hearing JFresh's spread trades. It's really easy. You wait till the gamma starts to collapse out of the money, and then you set up limit orders on spreads significantly above the spread value and see what fills.
Yeah, that's basically it.
Yeah. This is because at the beginning of the day, everyone's selling shitloads of zero DTEs. At the end of the day, they're closing them, or trying to close them, or ensure that they're going to close out of the money. So at the beginning of the day, the spreads are expanding. At the end of the day, the spreads are trying to collapse.
Yeah, I mean, that's the basic idea, is trade,
So you're arbitraging the end of day price action where they're trying to exit their spreads, or they're probably naked options.
Yeah, one thing I've noticed, I'm still kind of tweaking it. One thing I don't like about this spread strategy, and why I would like to improve it over time, is because yes, you're selling when people are buying, which is nice because you can sell high, right? But there's also a fair amount of volatility at the end of the day, so it is risky,
Extremely.
and it seems like the returns would be so much better if you spread out the spread and the legs of the spread, where you have to buy and sell, right? The spread is a buy and a sell, right? And everybody's selling in the morning and buying in the afternoon. So wouldn't it be better to buy in the morning, the buy side, and then sell the sell side in the afternoon? And it's just a matter of picking the right strikes to sort of, because if you can
That's what
get,
I've been doing.
yeah, if
Yeah.
you can get that buy side in the money in the middle of the day, then you can sell and just lock in prop. Then it's just, you just lock it in, and you can make even more than the spread. That's what I was trying to do on Thursday when I was buying those 45.70 puts that I ended up just holding into close, which was awesome.
Yeah.
In the morning, I was just like, all right, I'm
worry.
just gonna.
Don't worry. I was
I'm just,
there. I was there on Friday. I was up like 5,000 on puts, and I couldn't close them.
yeah, I had some. I did something similar on Friday too. I opened some puts, and then they win the money. Not anywhere near the extent they did on Thursday, but yeah, I had to watch them die. That pump was insane, though.
Fortunately for me, I opened my spreads for on Friday for Monday. So
All right.
I'm carrying a bunch of spreads over into the morning, where I'm then gonna go long, and I'm gonna use the price action Monday to close them out with the over the weekend theta benefit, which I think might work. We'll see. It was
Yeah,
either a great
we'll see.
idea or a really stupid one.
Yeah, I agree. You never know what could happen. Hopefully they were call spreads or were they put spreads?
They're both.
Okay, yeah.
Yeah.
Oof, good luck.
Yeah.
You're a better manager of strategies than me, so. Yeah,
I think
that's
the
basically it.
currently that the short puts and long, like the credit put spreads and the long debit spread are up, right? And then I can close those, and then on a pullback I can close out, because they're both like locked at like 75. So on a pullback I can exit the short side.
Yeah, I mean, I'm sure.
I think I'm profitable either direction, as long as the price moves tomorrow, and we don't just trade it like 45.75 all day long. And even then, I make a little bit of money. I guess at the money, if we close at 45.75, I make money also.
Yeah. Well, Dork, are you still out of town? Are you still on Traveler?
So mark your calendars, guys. Wednesday through Friday next week. If there was going to be a GSIB failure, it'd probably be on those days because I'll be super busy.
Well, we're about to supercharge that because this week I'm going to be on travel as well.
Shit.
So we overlap, it sounds like, on Wednesday and Thursday. So
yeah.
Market crash on Wednesday, guys.
Or Thursday.
Or Thursday.
I love how your guys' absence from market participation is the indicator for the crash. I'm just gonna buy puts and calls. I'm gonna do what I do every day.
Not a bad idea.
You said Monday wrong.
I mean, first time I went on vacation this year, FRC collapsed. Second time I went on vacation this year, the market rocketed up like 350 basis points. So, yeah, a fairly good indicator of variance at the very least.
Yeah. I did overnight spreads a few times. They worked far more often than they fail, but when they fail hard. Well, I don't have a margin of failure on the position. So they can't, like, if the market moves hard one way or the other, the debit spreads I have open are like 30 points wide versus the 5-point credit spreads. So yeah, I don't give a shit.
Yeah, and C-Mill, I would say
I'm already hedged against that.
I think that's irrelevant whether it's overnight or not. That's the issue with credit spreads is they work more often than they fail, just because you're selling them. You know, the delta and everything, you're selling a low probability of assignment, but when they do get hit, you get hit really hard. That's why it's Derek and I are trying to say, like, oh, if I can sell one of these $5 spreads for $3, right, then your reward is higher than your risk, which is really rare on these spreads. And it makes the chance of assignment higher, but it makes how much you lose lower. Whereas if you're just trying to sell way out of the money spreads or trying to sell a lot of theta on your spreads and you're getting like 5-10% on it, then you're just taking on a ton of risk for almost no reward.
Yeah.
So you have to be careful with that. That's kind of how I started in the spreads, and it didn't end up working very well.
On our last test of 4,600, I sold a 45.85, 45.90, or 45.80, 45.85 spread for 490. So that's 10 cents of risk on a potential $5 of profit, right? So that's what we're targeting, though. I only filled on one at that. I did a market order and I filled on one at that price. The rest were like 380. But yeah, you can like, with the amount of interest, because the spreads get blown out so hard, you can like really make a shitload of premium where you shouldn't be able to. The
And not only
market maker simply can't keep up with the gamma hedging, because especially at the end of the day, and that's why we're doing it at the end of the day, because gamma is expanding so rapidly that the premium value of the contract is fluctuating. I mean, it's the effective speed on the gamma and the contracts, but yeah, I mean, it's very difficult for the market maker to appropriately price the contracts, and so you get outliers that are extremely profitable.
Yeah, and this is just an artifact of just some people are just putting their fat finger on the buy button and just buying as many 0DTEs as they can in the last few minutes just to try to get that. Usually what it looks like they're trying to do is they have some strike that they'd like to defend to be in the money, and so they'll start buying the strike above to try and drag it up and keep that strike in place. And then we tend to oscillate around that strike that they're buying at the end of the day, and so it can swing quite dramatically from, like, I think Friday it was what, 45.80 or 45.85. It was 45.80, right?
Yeah.
Yeah, it was 45.80. It was like oscillating between like 45.84 and 45.77 over the course of, like, 10, 20-second intervals. It was just flapping wildly around those ranges, which is the difference between extremely profitable and extremely unprofitable spreads at that moment. But if you can capture, if you just basically take a step back and say, I'm the one in charge because everybody wants these calls, and you just set a limit for, an extremely profitable spread, if you're selling a 45.80, 45.85 for over $3 at the end of the day, even though, you technically lost because it closed at 45.82.24, you're still making 75 cents a spread.
Yep.
Yeah, it's crazy how you're able to do this. Like, it's actually the ability to do this just goes to show how far removed this market has become from reality in terms of, like, tail risk and pricing of risk in the market, at least in the ultra short term, right?
Yeah.
It's absolutely nuts. Like, the options market, like the pricing of options in the market is just it's completely insane.
I agree. Yeah, it's very advantageous, but it's very high risk. It encourages you to over leverage into spreads that are, you're taking on like a 50% chance of loss, and you're only scaling that down by attempting to collect more premium, like a greater premium than the midpoint of the spread, right? So they're extremely risky. They encourage over leveraging, which makes them even riskier. I would not actively pursue them if you don't have a ton of capital to throw away. There are much safer ways of doing this out of the money, where you're taking less risk on a slightly lesser return, but you're taking on significantly less risk. Yeah, these are not something to be done lightly.
Also,
yeah, I actually would prefer to avoid them altogether. My main strategy is more, an hour or two beforehand. If we get a big move in one direction or the other that's been pretty steady, and I start to see something, I start to see one of the call strikes breaking down, one of the high volume call strikes, then I'll start trying to sell spreads at the strike below that, because you can still get like $2 to $1 or $2 a spread. Now you have like 2 hours of risk you have to sit there, and it could plenty of time for it to just keep going. But once you start seeing that sort of call ladder breaking down, you can start to dip into it. And then usually most of the time when I'm selling these at the money spreads at the end of the day, it's because something has moved a little bit against me, and I'm just trying to raise my cost basis on the spreads that are now at the money that I didn't want them to be, just so I can, right? Because, like, I mean, I had some. I mean, that pump at the end of the day was extreme, right? And so I think I had two 45.80, 45.85s, and I sold two more at like 350, and it was at the money, and it was rise in cost basis from those two that may be profitable in the day.
I mean,
Otherwise,
I think
lost
everybody
money.
who was like watching the week before last when I had, you know, I was up like $2,500, and then the last candle moved up $5, and I lost $3,500. Learn that lesson from me. Don't take it.
Yeah.
Don't learn that lesson yourself. It'll hurt a lot more.
Yeah.
Well, especially as intraday volatility picks up too. Like we're in a strange point right now where like intraday vol it's starting to pick up like a tiny bit, although that's being fought against. But as intraday vol picks up, right, these tight at the money, in the money spreads, sort of the risk on them grows, quadratically, I think. So, like it may make sense, on big moves to sell spreads at certain points, but if vol is big enough and options traders are skittish enough on both sides, right, you could see a massive continuation in either direction.
Yeah, and I think the takeaway is
I've got a new, better way of doing this, but it's mine.
yeah, that's fair. But I will say, something I learned from spreads pretty quickly was that, and I mentioned this earlier, is just entries still matter, right? Just because you're selling like 3% returns, right? 3 days out, the market has to move 2.5% in 3 days, right? It's extremely unlikely that it'll happen. Well, then it happens, and you've risked, $493 to make
Yeah.
$7, right? And then of course you sell a bunch of those so that the money makes sense, right? Because you want to make a decent return, and so now you've turned like a potential $200 profit into a $4,000 or $5,000 blow up, right? So entries are still just as important for these spreads as any other position, right? You're not just like reducing risk just because you're selling them far out of the money. You're actually just doing what everybody else in the market is doing, and you're setting yourself up for a fat tail event.
Yeah. The opposite way.
Yeah.
A right tail event.
Yeah.
Nothing
Nothing hurts worse than getting blown up on a right tail event, let me tell you. When literally the whole world is making money.
Yeah. All right, guys. Well, thank you for tuning in. And guys, thank you for coming in and talking through. So did you have any thoughts on the BOJ stuff now that you've had a couple days to think it over, since I kind of walked you through it before we go? I know Dork weighed in on it a bit, but
No.
no.
I've thought about it a little bit. I think we just need a few more days to see what's going to happen. But
Okay.
I don't know. I don't know what the extent of the carry trade is. I don't know what the magnitude of it is.
Massive. JFresh.
We'll see.
All the money.
I mean, if that's true, then things are going to get spicy. What's the 10-year BOJ?
It closed Friday. Hold on. It closed Friday at 0.573.
They went quick on that.
Yep.
Look at that candle.
I know.
So
it's
cool.
okay though. The yen is worth less on Friday than it was Thursday.
Notice too the drop when SVB failed as well. Something else that's interesting.
Yeah, the bank failure.
Yeah. So I mean, it makes sense.
Also, look at December 22nd.
Yeah. Right. Like it makes sense to me because I mean, when yields go up and domestic yields go up in the short term, right? But you still need to borrow short to lend long. You go to the only business in town at this point, which is the Bank of Japan. And so,
yeah.
Well, they're the only ones with the liquidity, right?
Yeah.
Like there's there's other countries that have, like isolationist monetary policies, but BOJ is the only one with the liquidity to support this kind of bullshit. The other thing that drew me to this initially was that in Barr's testimony to the Senate, they became aware of the risk in SVB in December of 2022. And I was like, it took me a while to figure out what the fuck happened in December of 2022 before I could put all these pieces together, but yeah. and by here SVB was insolvent. So risk and then insolvency. So who's risk now?
Everybody. I mean, yeah, this looks to me like, I mean, especially knowing sort of the dynamics of lending, this just it screams systemic risk.
Mr. Poopy Pants, no trolling. Come on.
Such a dick. Yeah, I agree with you, Doric. I hope I'm right, because then we can make a movie.
But here's my question. If the solution to this risk is to pump equities, and the risk just got riskier, what's the short-term move? Are we just going to see it rocket?
I think so.
I mean, are equities just going to rocket for the next few weeks?
Well, there was some repositioning that occurred. Like, let's look at December, right? Like, the market reaction theoretically should be fairly similar to December 22nd, which was right here, right there. Unless, but here's the problem, right? So like this should be the expectation, right? Is that we get like a fucking another massive move up. But if this actually collapsed the trade, then it could just be the complete opposite, and that's kind of the problem with it, right? Like if the risk presented by this move is so great that the trade is no longer viable, then people are going to run for the exit really, really fast. And the difference between December and now is that the equity valuation is now very overcrowded, right? Versus December 22, where the equity valuation was very low. So here the solution is pump. But here the solution could be pump or sell.
Yeah, well, I mean that's the thing, right? Either you abandon the position or you pump, right?
Yeah. And I think the truth is going to fall somewhere in the middle, because I think some need to pump, some need to sell.
I think the likelihood is still on pump, just because selling, right, unwinding this is especially for everybody involved. The more that people that unwind this, the more are going to kind of jump on and do the same, and the effects of that in the credit market are going to be just absolutely crazy. We'll see yields go just through the roof.
But then that starts to hit the convexity hedge and the vol short, right? So if you're hedging your bond returns with convexity in the VIX market, like in VIX futures, then everybody half exiting and half trying to get in is going to create a shitload of vol and blow up. It's going to blow up the vol short.
Yeah, I mean, if all of this is true, and it is quite large, then likely we're going to get up, volatile up, then way down, or just straight down.
Yeah,
I mean, it seems like the music is running out on this. If all of this is actually true, and this is
remember that there's no more buyers up, and there's no more leverageable liquidity coming in, right?
The MM's always buying.
Huh?
The MM's always buying, and as long as they keep their margin up, they're fighting against their own margin, right? As long as they can pump. There's also not really a whole lot of sellers either.
But you saw how, I mean, we see how quick VIX can come back to life now. People aren't gonna quickly forget that.
Yeah. Skirk 8348. I know we've said this a lot, but maybe you haven't seen it. Don't buy VIX options.
Yeah, VIX options are overpriced.
VIX is a fucking scam.
If you want a volatility exposure, just buy a high vega, low theta, low delta contract on the SPX.
Yeah, you want long dated, out of the money with high vega on SPX or SPY has pretty high vega too. I mean, it's 1/10,
Yeah.
but sometimes SPY can exceed the multiplicative value of the SPX vega. So sometimes SPY actually has better vega positioning. It varies,
Yeah.
but
Yeah. So low theta is the same thing as high duration.
yeah.
So long dated is the same thing as low theta.
Yeah, the only issue is that you're fighting against.
Theta is a measure of how much the contract changes per day. So the longer it is, the less it'll change per day.
Yeah.
You have more days.
So theta value's lower, but you're buying more duration.
Yeah.
Gerk's saying buy lots of theta. JFresh is saying basically.
No. Yeah.
We're saying the same thing. Sort of.
We're just maybe not having the terminology is lacking, but yeah, he gets it. We don't need to belabor it.
Yeah, Gerk is in integral land. You're in the displacement
derivative.
land. Yeah.
So yeah, up then down, or maybe flat. It could either go up, down, or stay.
Well, I think if we trade flat, vol goes up. If not vol on VIX, I think volatility on every other product. So oil volatility, bond volatility, and then vol on indexes. But if we go up, I mean, that's going to compound vega exposure. If we drop rapidly, that's going to expand vega exposure.
So it's not a great spot.
Side. Yeah, it's a tricky situation. And we don't know who got the fuck out on Thursday, but someone did. And if they're big enough, that pull could be sufficient to break down more positioning, right?
Yeah, someone got out.
Someone got out
hard.
Yeah.
But then somebody else came back in and said, not today.
True, but maybe just not that day.
Yeah, we'll see. I'm excited to see what futures do tonight. But
yeah, me too.
Anyway,
I'm just excited to see what the news articles are looking like.
Yeah,
they've already started getting a little more bearish because we know that's the only people left are like what Merrill and Merrill. I think Merrill's the only one like really still in it. Citigroup, like everybody else is like downgraded SPX and been like, yeah, there's gonna be a recession or more inflation, but they're still like upgrading shit.
Yeah. So there was a bit of justice, by the way, some poetic justice. Tom Lee went on the air on Thursday, earlier in the day.
Yeah.
As Dow was going up and saying that this is irrefutable proof of our healthy, strong economy and markets, and then everything dropped 150 basis points.
That's amazing.
Yeah.
So
I heard Tom Lee stop talking about stocks on Friday and started pushing BTC to 150,000.
Oh yeah, it's gonna have. Okay, 2 points real quick because I know we already said we're gonna leave, but I don't know what you said about Siri, but I'm just gonna say this now so people can get a different perspective on it. T plus 69. So with Siri, the shorts are back in control. It looks like, and so now
we closed above 5 on Friday.
That's fine.
Okay.
But my point is that this is now a game of you kind of have to suss out are they going to get enough pressure to squeeze them out again, or are they gonna gain control of it? And the thing to look for is FTDs, and look at the borrow rate, and that can take 23 to 35 trading days or T plus 69 days to play out ish roughly.
I have an alternate theory. Good earnings, dividend might be enough. They're back to back.
Yeah, I mean, when's earnings? Is it this week or
earnings
next week?
Is on the 1st, dividends on the 7th.
Okay. Yeah, I mean, you could jump in maybe tomorrow and get a little bit of exposure, but I mean, this thing could drag out for over a month, just from continuous net settlement and depending on,
ETFs.
yeah. So I mean,
This whole like short move was like almost all propagated in the ETFs.
yeah,
So
and I mean, you could definitely see that the bar rates went up here. They dropped a little bit again, when it started going up there the last bit. So I would just say I'm not looking for this thing to pop soon, and it might not pop at all. So
yeah, I mean, I think
I
not at
don't
all is definitely something that everyone should be considering.
I don't want to hear people spending 80% of their energy and time talking about Siri. It should be a 5% or a round off. Talk about it 3% of the time. If
If
it's more
that.
than that, if it's more than that, you're thinking about it too much. Buy a
Yeah.
buy a leap, buy a leap, and see what happens. This is not like a big.
That's what I did.
I mean, come on, guys. How long ago was Rev? Wasn't even that long ago.
Jesus. I even, dude, the first day I started talking about it, I was like 90% chance it does nothing. And then people are like, so I'm full ported Siri. What's it gonna do today?
Yeah. The other thing I wanted to say was about crypto, because Tom Lee's moved to BTC and everyone's starting to get hyped for the halvening,
The
which
happening.
is basic. Yeah, which
Yeah.
if people aren't aware of it, basically every, what is it, 4 years? I don't remember.
Yeah.
The reward, so BTC operates by rewarding miners with new BTC, so it mints BTC to pay miners, right, to do the service of confirming the transaction, right? Which then they can convert to cash. And so the conventional wisdom has always been, every time the halvening occurs, which is halving the amount of BTC that miners earn for successfully mining a transaction, the price of BTC relative to dollars must go up, right, to make it worthwhile for the miners to mine. And so people have been saying for a long time that these halvening events are what are causing these massive increases in price for Bitcoin. I would pose an alternative thing that could also happen eventually, is that eventually, considering that Bitcoin doesn't provide any value in the sense of it doesn't maintain its value, it's not a transactional currency, it literally does nothing, that raising the price to trade it might just cause it to become undesirable to trade at all. And so the alternative thing that could happen, and will likely happen eventually, unless somebody just figures out a use for BTC, is that people will just abandon it and it will die. So take that for
Yeah.
what it's worth. People are getting hyped for the halvening. Yes, all of the previous halvenings have led to dramatic increases in price, but we're kind of getting to the point where people are running out of, margin on this.
So what you're saying is straddle the happening?
I
That's all I
suppose. Yeah, I
heard.
don't.
Yeah. I
I
just
don't
heard
know. I don't know how to. I don't know how to do derivatives
BTC
on.
futures.
Oh yeah, that's right.
Yeah, that's
You don't. Even,
right.
you
That
don't
is
even have
right.
to buy. You don't even have to buy crypto. You can
No.
just play the futures markets. Yeah.
I don't want to own that dog shit.
Hmm.
Yeah.
That actually doesn't sound bad. I hope it goes to zero though. I hate crypto. I'm over it.
Short MSTR and buy BTC futures. All
Yeah.
right, guys,
Anyway,
that's enough of
those are my
this. It's
thoughts.
almost 3
Yep.
o'clock. I have shit to do today.
All right. Yep. All
Thank
right.
you both
See you
for
guys.
coming on. I appreciate it. I'll see you guys later.
Thanks for having us.
You got it, man. Thank you all for hanging in there. If you guys have any more questions, feel free to hit me up. I will be around for most of the rest of the day. Pickles Picks will be out tonight. The standard format of updating every night is probably like the new standard format of updating every night is probably going to continue this week. I think there's a lot of potential things that could be happening this week, and we're going to be keeping an eye out for them day to day, especially with the month ending. So thank you guys all so much. Have a lovely night. Enjoy the rest of your weekend. I'll see you later. Bye.